ANZ's and NAB's moves this week to simultaneously jack up mortgage rates while scrapping exit fees has injected a new element into an old and heated debate, apparently arguing both for and against the idea that there's little competition in Australian home lending. So what is the problem? And more importantly, what's the solution? I spoke to Dr. Nicholas Gruen, an independent economist who's currently studying the issue and also has some skin in the game, running a small mortgage broking business. Well, Nicholas Gruen, everyone, including me, thinks that removing exit fees from mortgages would improve competition because people would be able to switch from one bank to another. But what haven't we thought of?
It's a complicated story, but one thing you can think of is that the innovators who have come into the market, who have typically driven prices down, driven interest rates down.
You mean the non-bank lenders?
In non-bank lenders have typically had to cover the risks of going in and then having the mortgage refinanced off them in exit fees. I think it's a complicated story, but it's certainly a great way to get things wrong, to just see a thing and say, well, if we regulate that out.
Would you go as far as to say that there wouldn't have been the competition from non-bank lenders when it occurred?
No.
Without exit fees?
No. Well, no, but it would have been less aggressive and it would have grown more slowly. So an exit fee is a way that someone with a proposition for the market, which is, I think I'm qualitatively better than anyone else, but I've got some risks in terms of tying up funding that I've got to cover. So it's in a sense, it's joint venturing with the borrower for a new product. And early on in a product cycle, that can be important. Now, the problem is, then other lenders see that and say, good, well, we'd like some exit fees on it as well. So it's just a complicated story.
So ANZ, at the same time as announcing a 39 basis point rate increase, dropped its exit fees voluntarily.
Exactly.
Were they giving up much?
They were, in many ways, focusing on their competitive advantage, which is that they've got very deep sources of funding, and if somebody ends a loan with them, they can find another way to get that money, get it to work quickly. A smaller lender that was using securitisation would have more trouble doing that. And so one thing that ANZ was doing while it was jacking up its interest rates was to play to its own strength by reducing exit fees.
So would you flip it around to say that you actually need exit fees in order to get more or a revival of non-bank lending competition?
No, because what's really holding back non-bank competition are a whole range of competitive non-neutralities with balance sheet lending, that is with banks.
Explain what you mean by non-neutralities. You mean that the playing field's not level?
The playing field is not level, and basically there are two ways of funding a home loan, and one is off a balance sheet of a bank and the other is to to parcel up a bunch of loans and sell them to investors. Now, if you have a balance sheet, you've got the Reserve Bank standing behind you, you've got a whole 100 years of institutional development to protect your liquidity. You can you have a lender of last resort backing you up. Securitisers don't have any of those things, and not surprisingly, the cost of funding through securitisation is still quite a lot higher than balance sheet lending, and the banks are cleaning up.
But is it fair to say that the support that banks get has become more obvious and in fact greater, during the GFC?
Absolutely, because what happened was that the liquidity in the marketplace, which was driven by investors trying to find returns, suddenly dried up as they found out that the world was a dangerous place. And what happened then? Well, governments around the world went down to their local banks and said, what can we do to help? And they didn't do anything like that to the securitisers. The securitisers are on their own. And in fact, as you might recall, as happened with cash management accounts and things like that, which are also another securitised product in a different kind of way, once the banks were guaranteed by the government, once deposits were guaranteed, money started flowing out of this shadow banking sector and into the banks. So the banks won both absolutely and additionally relative to all these alternative ways of doing finance.
Right, and in Australia, Australia is congratulating itself for having got through the GFC in such great shape because of the strength of the banking system. But now everyone's woken up to the fact that actually the banking system is so strong, everything else is absolutely weak.
Yeah, well, it's incredible. One of the latest reports was the bank sitting on an 18% return on equity. This is a system which is supposed to be losing money at a time like this. You know, it makes money in the good times. The return on equity during the global financial crisis of our banks never fell below 10%. Now it's back up to 18%. This is a ridiculous return.
Well, okay, so if the answer is not removing exit fees entirely, that may be part of the answer, but what is the answer? What needs to occur for there to be proper competition in Australia in banking?
We're sort of 75% of the way there before the GFC, realising that securitisation, this alternative source of funding, can be a powerful competitor with the banks. What we did wrong, and I might say I was one of the people right at the time who was saying we were doing it wrong. Almost all the things that government did, it did right, and the mistakes that it made are understandable in the rush that it was in. But from, I think it was about June or so, 2008, me and a number of other people were saying the securitisation market is simply collapsing and you're propping up the banks. Help provide a support to securitisation which enables it to continue functioning, and then over time try and make sure that these things are on a level playing field.
Are you saying that since the government guarantee, or implicit or explicit, can't be removed from the banks, then the securitisers or the securitised mortgages have to be guaranteed?
Yes, I am saying that, but they don't have to. I mean, obviously you then have to say, well, guaranteed by how much and in what way. It's too simplistic to just say, oh, the government's going to charge off and guarantee all mortgages. But for instance, in Canada, there is a government-owned mortgage insurer, and if a bank holds a mortgage on its balance sheet, that counts as equivalent to holding a government bond. One way of looking at that is they've taken prudential regulation of home loans. They've set up prudential regulation of home loans before the loan ever appears on anyone's balance sheet.
Well, are we just suggesting a national scheme of mortgage insurance focused on the mortgages themselves rather than the institution?
If you ask yourself the question, how do we get competition in mortgages, you might solve those problems out by looking at the mortgages rather than the institutions. Once you've done that, then it doesn't matter what institution ends up funding the mortgages.
So in another effect of that would be that the banks would have to pay for the implicit insurance that they currently have.
Precisely. So the banks are currently benefiting from once-in-a-generation handouts, effectively, which are in the form of guarantees, and they would pay for those guarantees over the course of 20 years or whatever, and then when it came time to draw them in, they weren't getting something for free. In the meantime, the securitisers have got some form of guarantee, which they've paid for, and then the market for securitised loans starts to function in a way which is on a level playing field with the banks.
Thank you very much for joining us, Nicholas Gruen.
Thanks, Alan.